Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Hello, Jim.
And hopefully spring has arrived in Ontario?
Nope, not yet. Still freezing, still gray, still ice everywhere. Pretty miserable.
and here in Vancouver, we're celebrating 54 different varieties of cherry blossoms.
Ah, lovely.
Sorry to tell you about that.
Yeah,
Danielle,
that's okay.
The Bank of Canada did not raise interest rates. Are they going to have to sooner or later, and is that going to be a good or bad thing?
Well, it's a complex question because they do want to get off the near zero bound. They're only at 1.25% as an overwrite rate, which is well below the historical norms for that base rate. And they certainly would love to get more room between where they are now and higher rates so that they have more flexibility to cut rates when the next recession arrives. The trouble is that they have a disappointing economic backdrop right now. Data keeps coming in undershooting what was, 6 months ago. There was great hope that U.S. corporate tax cuts and, the Trump administration shaking things up in the U.S. would, be stimulative for growth. But actually what's happened is that U.S. corporations have just doubled down on share buybacks and dividends and financial transactions that boost their debt and don't do a thing activity or spending or anything that really helps drive the economy. And so that's been a flop. So growth is disappointing.
Danielle, you were saying the Bank of Canada wants some wiggle room here. How fast can they do it without upsetting the apple cart the way it is right now? Did they just wait too long to do this?
So they're dealing with slow global growth, and it's in a negative trend. And they're dealing with a Canadian economy that has never been more indebted. So every time that they edge rates up, even though they're still at a modest level, it's a proportionally large impact. And so we have, already got wobbles in Ontario real estate over here. The price trend has been quite negative over the last year. We've got a stress scenario rising in borrowers. We have, defaults mounting. We have stuff coming off the rails in the subprime auto market where we've been discussing over the past couple of years how, super long leases and easy to get people into cars, but very difficult for them to get out from under the weight of the debt that is now accumulated. So I think that they have to keep talking up the idea of raising rates. I know they certainly want to, but they blinked again. That's the second month in a row. The next meeting is May the 30th. And we'll see, if they get to increase one more time, that may indeed be all they can manage this cycle. We've really run out of runway here in this expansion. The stock market may have peaked in January, and the credit markets certainly are flattening significantly in terms of yield spreads. All of these things are precursors to economic contraction typically. And so if we're already at that recessionary part of the cycle within the next, say, 6 to 12 months, we could even see that starting, then it's going to be very tough for not just the Bank of Canada, but for all the central banks to do the hikes that they are talking about. I mean, the U.S. Fed, under new Chairman Powell, has talked about 7 or 8 more hikes in the next 18 months. I think that's just, wildly optimistic. Now, he's also said that he doesn't care if, he's not there to placate stock markets, and if things start to sell off, then that's going to be no excuse for them to veer from their tightening path. But I don't believe him. I hope and wish he would do that. I wish he would do the right thing to set the economy up for more sustainable growth in the future by putting rates back to more normalized levels and letting the chips fall where they may. But I'm not convinced that they have the gumption to do that. The Bank of England under Mr. Carney blinked again this week as well. So this is a trend where they were all, forecasting great growth as they do, and as the data comes in disappointing, they're sort of kicking the can in the hopes that maybe the next report will be better. But we'll see. I think we're in the disappointing phase here of the economic cycle.
We'll have more with Danielle Park right after the break.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Welcome back. We're speaking with Danielle Park. Doug Ford, the leader of the Ontario Conservatives, says if he's elected premier, he will remove provincial income tax from people making minimum wage salaries. Is that a good idea?
Well, we have to do something to get money from the top 1% back down into the pockets of the bottom 50%, let's say. Most of the 50% of lower income earners don't pay any income tax as it is, with the various credits and rebates that are given. So I'm not sure that although that's a nice promise and may indeed be one of those populist statements that wins him some votes, it really doesn't make much difference in terms of the big picture. As I say, most of the people in that income bracket are not paying much in the way of tax to begin with in terms of income tax. So I don't think it would make a huge difference. But I do think that, ideas to get money into the pockets of the masses is what we need to do. We need some kind of transfer payment here. The more concentration we just keep doubling down on cutting taxes and increasing wealth for the top fraction of the population, the slower the economy is moving. The more indebted the economy is, the more wages stagnate. This is really this negative feedback loop, which has accentuated over the past couple of decades, but in particular since the 2008 recession, where the wage growth just hasn't been there. While financial gimmicks have been the mainstay of corporations, the level of corporate debt, as an example, has increased 45% since 2012. And yet earnings have been flat to negative. So even with all this financialization that's going on, they haven't been able to sustain a trend higher in earnings. And the difficulty is that it's very well documented in economic history that the only way that you can really improve the standard of living for the nation as a whole is to increase productivity, to make things more efficient, to make costs get people so that people can have more with the same or more income. And what we've got now is this very negative loop where, only this tiny fraction of people are making more money and riding sort of asset bubbles up, and productivity has been falling and waning, and wage growth has been stagnant and negative for the masses. So we're really stuck, and unless we figure out a way to, as I say, share the wealth more through the economy, we're really not going to be able to make much progress. And also, with the demographic weight, of the aging population. That's another thing that's going to hold back our progress here. So we really have to get innovative. Steve Keen was talking, the economist was talking in a recent interview about the idea of, giving $10,000 to everyone, and if you have debt, you have to use the $10,000 to pay down the debt. And if you don't have debt, you have to use it for investment purposes. I mean, that's a sort of a radical sense of the idea. The other one is that minimum income idea of, giving everyone a flat amount of money, so that everyone can have some consumption ability. I mean, these are pretty radical outside the box ideas, but we're really stuck right now. The old models we've been using for the past 30 years have driven us really into a corner, and in order to get out of it, we're going to have to get much more creative. The old saying, Jim, as you know, is that saving is present consumption denied. The problem is that debt is future consumption denied, and the world now has some $237 trillion worth of debt, much higher than it's ever had before, and that means that we are into this phase where future consumption is weak because of the weight of that debt, and that's even if rates don't go much higher than they are at present.
We'll have more. Danielle Park, right after this.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Before we went on air, you were talking about Dieselgate. Can you tell us about that?
I was mentioning there's a great new series on Netflix called Dirty Money, and it's by the people who did the Enron documentary Going Clear. Very well done, and each episode focuses on a particular segment or story about a corporation or a sector. And the first one in the series is on the Volkswagen scandal, which is, just an outrageous example of corporate fraud on a massive scale, and not just in Volkswagen, of course, but through many of the German car makers. In fact, what's really brought forth in that documentary is that it's still ongoing and endorsed indeed by loopholes where the governments in Europe, allow them to allow these car makers to get around the emissions controls by saying that if they, if they don't do it, it's harmful to the engine, which is this ridiculously circular argument. Meanwhile, at the end of the day, we have still this horrendous impact on air quality all over the world. Just in Europe alone, 10,000 people a year are estimated to die from lung infections due to the metals and contaminants that are in the air from all this diesel emission. And like a handful of executives were penalized for that. One went to jail. The rest of them, the CEOs at the top, basically have been unscathed. No one's taken their bonuses back. So it's really just a horrendous example of abuse. And we've got a lot of this type of business model all over the world right now. The corporate sector's really been freewheeling and doing whatever it wants, and we're all sort of paying the price of that in many different ways, not the least of which is health impact. So I think it really behooves people to watch that stuff, as enraging as it is, as frustrating as it is, but we have to admit in order to reform it. And so it's there's a lot of great material that's available now. One of the good things about some of this new media companies is that there's a much wider platform to learn about these topics. So anyway, I just think I noticed that the next one is on payday loans. So I'll have to summon the strength and stomach through that, because you and I have talked about payday loans in the past, and they're such a scourge on humanity. But there is another story there about how they have managed to circumvent the laws and really bankrupt the poor. And it's like the U.S. subprime fiasco all over again. And we're seeing that in subprimes really made a comeback this cycle in many different ways. This being lending to people who really can't afford to pay it back. And the way that they've done that is they've called them non-prime lenders this time instead of subprime lenders. And this is infiltrated through, like I said at the beginning, through the auto market, but also through home loans again. People are, and we've seen this even in Canada, where non-mainstream lenders have been utilized in the past few years increasingly to allow people to overreach for houses they really can't afford. And, at double-digit interest rates, 2 and 3 mortgages on a property. I mean, it's just ludicrous fringe. And what happens is, of course, that people get paid fees up front and the lenders make a few quick bucks, and then in many cases they securitize these loans and sell them to so-called investors who think they're making off like bandits with these high rates of interest. But of course, the default wave then hits, and the losses flow to the investors. The folks that couldn't afford the houses lose them, and even the others around them who weren't highly levered end up suffering losses because it suppresses the property markets in the areas where they own homes. So there really is no win out of these scenarios. It's just all short-termism and quick bucks up front for a few at the expense of the longer-term strength and stability again. So we really have to figure this out and realize that we can't afford to continue.
The IMF says the global growth rate for the year should be 3.8%. Do you believe that?
Well, the IMF is, certainly one of the places that does these calculations each year. Keep in mind that, in the peak of the growth boom into 2007, you were seeing growth rates above 5%. And so when they talk about this, that's essentially stall speed for the global economy. Anything short of 4% is typically considered a stall speed, because don't forget this is an average of developed and emerging markets. China came out, for example, with its growth estimates for the first quarter of 2018 and reported, wait for it, that it's 6.8% again, which is, just the plug and play that they always use in terms of numbers. But in fact, when you look at it on a more objective non-party line basis, it looks like the growth rate in China has slipped below 5%, more like 4.5 or 6%, in which case, they're supposed to be the star turn, the engine on fire. What you find is that, again, back to the old story of debt, where, they added all this debt after the financial crisis to try and jumpstart the global economy. And, back then adding, another dollar of debt got them a good kick, maybe 62 cents of growth in their GDP or something in that area. And now as they're adding, another dollar of debt, they're getting maybe half that benefit. So again, saturation in the global economies and emerging markets, too much debt, too much cash flow going out the door just to service it, and they're seeing this downtrend in their sales and revenues and exports, not to mention all the protectionist rhetoric that has come up, in the last sort of 4 months with the Trump regime. So I think, again, we've had a very long expansion. It has gone on much longer than it would have on any kind of an organic or natural basis. But the cost of the extension has come because of the debt that has been used. And as I said, that means future consumption will be weaker because we pulled it forward and spent it on debt in the past few years. So we're going to have a difficult phase here, and people should be prepared for it. It means that, you can't have an expansion that lasts forever. We're almost at the longest expansion that ever happened, and the last one was in the 90s, at the beginning of the 90s, when asset valuations were much lower. Valuations were a fraction of what they currently are. So there was much more gas in the tank, so to speak. Debt levels were a fraction of what they currently are. So now we're already pushing up against the very longest cycle ever in history, and we have no gas left in the tank because of all the savings depletion that's happened.
Danielle, thank you so much for chatting with us.
Hey, thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. You can forward questions to us and our guests at info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.